Welcome, everyone. So far in our journey through accounting, we've mostly dealt with certainties, things that have already happened. But today, we're going to shift gears and move into a much more complex and, frankly, a much more realistic part of financial management. We're moving from just being a bookkeeper who records the past to becoming a strategic financial manager who has to anticipate the future. We're going to tackle a concept that's absolutely fundamental for any business leader. How do we account for promises that we know, just based on experience, are going to get broken? This is the reality of bad debt, and trust me, understanding it is crucial for knowing a company's true health and for making smart decisions.
All right, let's frame our whole discussion with this one big question. You see, to compete, to grow, pretty much every company has to sell on credit. It's just a necessity. But the second you make that sale on credit, you create an asset on your balance sheet called an accounts receivable. Now, this asset is fundamentally different from cash in the bank or inventory on a shelf. Those things are tangible. And accounts receivable, well, it's just a promise. Its value is based entirely on a customer's word that they'll pay you later. And as we all know, promises can be broken. That is what makes it one of the absolute riskiest assets a company holds. So figuring out how to measure and manage this risk isn't just some accounting exercise, it's vital to managing a company's cash and its long-term survival.
So let's really dive in. We'll start by taking this very real business problem, the risk that someone won't pay you, and translating it into the very precise language of accounting. Before we can even look at the methods for estimating bad debts, we have to have a crystal clear understanding of the accounts that are at the very heart of this whole thing. And this isn't just a vocabulary lesson, okay? Mastering these definitions gives us the framework for our entire analysis and for the financial statements you'll be responsible for in your careers.
Okay, let's turn our attention to the balance sheet. If you look under assets, specifically current assets, you are always going to see a line item for accounts receivable. Now, it is absolutely critical that you understand that this one number isn't just a single thing. It's an aggregation. It's the sum of maybe hundreds or even thousands of individual promises from all your customers. It represents the future cash the company expects to collect, and because of that, it's a huge part of a company's liquidity. Lenders, investors, they look at this number very, very closely. But you have to remember, its value is only as good as the promises it contains. Our job is to figure out how to present that value honestly.
So what happens when some of those promises are, inevitably broken? We can't just pretend it didn't happen. We have to recognize that economic reality on our financial statements. And we do this with an account called bad debt expense. This is an operating expense. You'll usually find it under selling, general, and administrative expenses on the income statement. I want you to think of it this way. It is the cost of doing business on credit. It's the company officially acknowledging that, hey, in the process of making all those sales, a piece of that revenue is unfortunately never going to turn into cash. And it directly reduces our net income, which gives us a much more realistic picture of our actual profitability.
Now, why is this so critical for you as a future manager? Let's just imagine for a second that we ignore this whole reality. Let's say we report our full accounts receivable balance as if every single dollar is going to be collected. Well, our financial statements would become dangerously misleading. On the balance sheet, our assets would be overstated, making the company look way healthier than it actually is. And on the income statement, our net income would be artificially inflated because we haven't recognized the cost associated with those credit sales. You're painting this falsely optimistic picture that could lead a manager to make some truly disastrous decisions. For example, you might look at that high net income and say, hey, let's expand into a new market, or let's take on a huge loan to buy new equipment. But if that income isn't backed by real collectible cash, you might suddenly find you can't pay your suppliers, or your employees, or that new loan. This is how companies go bankrupt.
The solution here, and this is a key takeaway, is not to wait until we know with 100% certainty which specific customers won't pay. I mean, in a big business, that could take years, and by then the information is totally useless for making decisions. Instead, generally accepted accounting principles, or GAAP, they require a prudent, proactive approach. We have to estimate. So now, let's explore the core accounting principle that tells us how we acknowledge this uncertain future reality on today's financial statements, and that is the principle of estimation.
This quote right here gets to the absolute heart of accrual accounting. The goal isn't to be a psychic, right? It's to make a reasonable and systematic estimate. Now, the specific rule that is non-negotiable here is the matching principle. The matching principle is a cornerstone of accrual accounting, and it says that expenses must be recognized in the same period as the revenues they helped create. Think about it. The risk of a bad debt was created the moment we made that credit sale back in January. Therefore, we must record the estimated bad debt expense in January too. We can't wait until December when we finally give up on collecting from that customer. This makes sure our income statement for January accurately shows the profitability of what we did in that period. It matches the cost, the bad debt, with the benefit, the sales revenue.
Okay, so theory is great, but how do we actually do this in the real world? Let's dive into our first of two very common methods for making this estimate. This one is called the percentage of sales method. I want you to think of this as the income statement approach, because its main goal is to get the expense number right for the income statement. It's all about getting that perfect match between the revenue and the bad debt expense for the period.
The logic here is really simple, and it's powerful. You can see how it follows that matching principle we just talked about perfectly. It's a pure cause and effect model. The company looks at its own history and says, historically, for every $100 of credit sales we make, about $2 on average have gone bad. So it's pretty reasonable to estimate that the same percentage will apply to this period's credit sales. The cause is the credit sales we made this period. The direct effect is the bad debt expense we're going to recognize in this same period.
And it really is a straightforward three-step process. First, you analyze your past data, maybe 2, 3, 5 years back, to find your historical uncollectible rate. Now, a very common mistake here is to use total sales. Remember, you have to base this on credit sales only because cash sales have zero bad debt risk. Second, you take that historical percentage and you apply it to the current period's total credit sales. And third, the result of that simple math is the bad debt expense that you're going to record for this period.
Now let's put some numbers to this to make it real. As you can see here, let's say our company had $500,000 in credit sales this year. Based on our analysis of the last 5 years, we know that about 2% of our credit sales will probably end up being uncollectible. So the calculation is simple. We take the $500,000 in credit sales and we multiply it by our historical rate of 2%, or 0.02, and that gives us a bad debt expense of $10,000 for the year. This is the number that's going to show up on our income statement as an expense, and it will reduce our reported profit.
And this slide shows you the journal entry, the actual mechanics of how this gets recorded in the accounting system. We debit bad debt expense for $10,000. A debit to an expense account increases that expense, which in turn reduces our net income. The matching credit goes to a really fascinating and important account called allowance for doubtful accounts. Now listen carefully. This is a contra asset account. A contra account does the exact opposite of what a normal account in its category does. So since assets normally have a debit balance, this contra asset account has a credit balance. It sits right there on the balance sheet paired directly with accounts receivable. So you'll see accounts receivable, and right below it, you'll see less allowance for doubtful accounts. This reduces the net value of our receivables down to a more realistic number. Think of it like a reserve or a holding account that we build up to absorb future write-offs when we finally identify a specific customer who won't pay.
All right, let's move on to our second method, which shifts our focus entirely. If that first method, the percentage of sales, was what we call the income statement approach because its goal was perfect matching, then this method is the balance sheet approach. Its primary goal isn't to calculate the expense for the period, but to make sure the asset value on the balance sheet is as accurate as it can possibly be. It asks a completely different but equally important question about our receivables.
With this method, our main concern isn't matching the expense to this period's sales. Instead, our goal is to make sure the accounts receivable asset on our balance sheet is reported at its net realizable value, or NRV. That's a key term you absolutely have to know. Net realizable value is just the total amount of receivables minus the amount we estimate we won't collect. In simpler terms, it's the amount of cash we actually, realistically expect to get. So this method looks at the whole pool of outstanding receivables at the end of the period and asks, what is this asset really worth today? This method, which we often call the aging of receivables method, is more complex, but it's also generally more accurate. It acknowledges a simple truth of business. The older a receivable gets, the less likely you are to ever collect it. So we start by creating an aging schedule, where we group our receivables into time buckets, like 0 to 30 days old, 31 to 60 days old, and so on. Then we apply different increasing uncollectible percentages to each of those age buckets. We add up all of the estimated uncollectible amounts. Now, please pay very close attention to steps 3 and 4 because this is where most students make a mistake. The number you calculate is not the expense. I'll repeat that. It is not the expense. It is the target balance we want our allowance for doubtful accounts to have at the end of the period. The expense for the period is just the plug figure, the amount we need to get the allowance account from where it is now to that calculated target.
Look carefully at this aging schedule. What we're doing here is a quality analysis of our assets. We can see that for our newest receivables, the ones under 30 days old, the risk is really low. We only expect 1% to go bad. But look at the receivables over 60 days old.
our experience shows a much higher 20% default rate. Now, as a manager, this tells you something. Maybe your collections department needs to get more aggressive with those older accounts. By summing up the estimates for each bucket, the $800, the $750, and the $1,000, we determined that to accurately value our receivables on the balance sheet today, we need a total credit balance in our allowance account of $2,550. This is our target.
So this slide illustrates the most critical point of this whole method. Let's walk through it. Our aging analysis told us that the required ending balance, our target, for the allowance account is $2,550. Now, before we make our adjustment, we look at the account and we see it already has a credit balance of $1,000 from previous period's estimates. Therefore, the bad debt expense for this period is only the amount needed to bridge that gap. We take the target of $2,550, we subtract the existing balance of $1,000, and that gives us the expense for this period, $1,550. This is the number one mistake students make on exams. They correctly calculate the required allowance of $2,550, and then they incorrectly call that the expense. Remember, the expense is the adjustment you need to make to reach the target balance.
This slide does a great job of summarizing the different philosophies behind these two perfectly valid gap methods. The sales method, on the left, is all about the income statement. It gives you a superior matching of expenses to revenues in a given period. The receivables method, on the right, is all about the balance sheet. It gives you a more accurate, up-to-the-minute valuation of your accounts receivable asset. So which one is better? Well, it really depends on what the company wants to emphasize. If their main concern is showing consistent profitability from sales, they might lean towards the sales method. If their main concern is showing lenders a very accurate picture of what their assets are worth, they'd probably prefer the receivables method.
All right, for the last part of our lecture, let's step out of the accountant's shoes for a minute and into the manager's office. For those of you who are not accounting majors, this is the most important part. Why did we just spend all this time on these estimation methods? Because this number, this seemingly small accounting estimate, directly influences major strategic business decisions. It tells a powerful story about the health of your company's operations and your customer base.
Consider this. Let's say a manager who's under a lot of pressure to meet quarterly targets pushes the accounting department to use an overly optimistic estimate for bad debts. This could mean your company's reported assets are overstated by a huge margin, maybe 10, 15, even 25% as this slide suggests. This can hide a serious cash flow problem that's just simmering under the surface. You might go to the bank for a loan to fund an expansion, showing them this healthy-looking balance sheet. But a smart loan officer will do their own analysis of your receivables, and if they find out your assets are inflated and that the cash you're promising probably isn't going to show up, your loan will be denied. This is where accounting hits operational reality hard.
As future business leaders, you have to be aware of these common analytical pitfalls. First, a frequent mistake is just blindly using old data. If the economy goes into a recession, your historical 2% bad debt rate from the good times is probably irrelevant and dangerously low. You always have to adjust your estimates for what's happening in the world right now. Another huge mistake, as we just spent a lot of time on, is confusing that target allowance balance with the actual expense for the period. And finally, from a management point of view, the biggest failure is not acting on the data. If you see your bad debt estimates are consistently rising, that's a signal. It might mean you need to tighten your credit policies, or invest in a better collections process, or maybe even stop selling to certain high-risk customers. The numbers are telling you a story. Your job is to listen and then make a decision.
So I'll leave you with this scenario to think about as you move forward. You're the manager. Your historical data from the last 5 good years says your bad debt rate is 2%. But you read the news, you see your customers are struggling, and you know a slowdown is coming. Your internal accountant presents you with the numbers. If you stick with that 2% rate, your reported profits stay high, and you and your team get your annual bonuses. But your professional judgment tells you the real number is closer to 5%, which would significantly lower reported profit and probably wipe out those bonuses. What do? This is where accounting moves beyond just numbers and meets strategy, ethics, and leadership. And your decision will tell a story not just about your profits for one quarter, but about the long-term health, integrity, and credibility of your company and of you as a leader.